In this video, we'll be looking at investing in management and some of the objectives discussed that will help us understand the concept of investing in management include defining what the term management is, looking at some of the successful characteristics of strong management. And we will use that to then look at one successful case and one failure case to try and create some context for what good management is and what poor management is. And we will finish with the value, a bit of a stress on the importance of evaluating management. But first, we will begin with what the definition of management is. Well, it accounts for the people who are involved in the administration of a business. So whether that means through the finance side of business, the operating side of business with operations, or the side of marketing, or the side of human resources or HR. Management accounts for those who are involved, those that are managing the business and helping shareholders achieve value. In terms of business, that is the important side we should consider. And strong management must always, as a business, have the best interests of all their shareholders in mind. If you buy shares in a company, you'd hope that the managers of that business have your best interests in mind. We'll now look at some of the successful traits of good managers in business. So let's pull the first one up. Transparency. That is important. You want to invest in companies that are managed by open and honest individuals, essentially managers that operate with a high degree of transparency. As an investor, you expect to be told the truth, whether the news is delightful or upsetting. And it's also important to have loyal managers, those that would decline an offer to move elsewhere in a heartbeat. And if you've already listened to our podcast about Coca-Cola, you might recall the impressive loyalty presented by the firm's early directors. They literally used up all of their time marketing Coca-Cola drinks to individual communities across the US, anything from road trips to door-to-door sales. And a team of loyal members can only grow as those within want to be a part of something special and see its success through. You've also probably heard of the term skin in the game, used a lot in the investing community. Well, when a manager purchases and retains shares in the company they work for, they are classed as having skin in the game. It's important to consider how much the manager or managers actually have invested into the business. So for example, a manager could receive millions a year, but only decide to buy a few thousands worth of the company's shares just to keep shareholders happy. Well, that isn't a strong sign for investors. That scenario isn't at all, of course. But this isn't a clear-cut signal, as we cannot make assumptions on the basis of a manager's personal financial situation, because after all, we're human. A loyal manager could be experiencing personal financial issues and thus may be forced to sell shares. But from the outside, we only see the event of the manager selling, and we'd probably sell thinking that there's something wrong when there actually isn't. In the past, we've also seen companies take large risks in acquiring other businesses or assets, and these risks can sometimes pay off hugely. Management that seeks to strategically invest its cash reserves can deliver higher returns for investors, assuming that these acquisitions pay off. And now this is why the degree of success with respect to management's approach to acquiring other assets is extremely important to consider. If a business can strategically acquire assets that are cash generative and ultimately profit making, then that is the kind of management you want to be parting your cold hard cash with. Now, responsibility is another characteristic of strong management. As we've seen with BP, an oil and gas exploration and production company, a lack of responsible management can lead to chaotic losses as a result of direct carelessness. Sometimes a firm will cut corners. You see it in small businesses, you see it in large businesses. They'll sometimes cut corners to improve their profits, but these measures could lead to fines as a result of malpractice from damaging the environment or people's property. And that is a very unfortunate situation, but some managers can also be creative. They work to come up with innovative methods to reduce costs and improve profit margins without breaking any regulations. So Netflix, for example, came up with an algorithm that used member watch history data to recommend future films and shows for their users to watch next. And this made Netflix stand out in its market, seeing constant growth in paid subscriptions for their platform. We're now going to look at an example of Elon Musk and Tesla. Elon Musk is one of the most important managers of the business that's publicly listed by the name of Tesla, and he has a lot of skin in the game. He owns roughly 20% of Tesla's shares. He also was so loyal to the firm that sometimes he would sleep on the factory floor and he wouldn't even have enough time to go home and shower. This is a crazy quote directly from some employees at the time. And you can see, using these elements, we looked at skin in the game, we've looked at loyalty, and we've also got dedication of creativity to improve Tesla's vehicle offering. These three elements we've mentioned, skin in the game, loyalty, and creativity, are just some great examples of strong management, and these led to what we'll see as the strong performance of their shares. Let's look at a period here, the 19th of August 2019. Remember, this is a weekly chart, so that's the week beginning the 19th of August. So when that 5-day week ended, that's where we get the $42.20 price from. And the price change to the 4th of September, around 52 weeks of trading data, was 891.28% of an increase, an impressive increase as a result of strong management. And just for some reference, if people are confused about the price points used here, there was recently a stock split, as you can see by the sign S here. And to get the price pre-stock split, you just have to times each bit of data that you have now by 5. So $42.20, approximately $210 a share. That was really what it was before the stock split. But the price change in terms of percentages works out to be the same, so don't worry about that too much. Now we're going to look at a failure case. Mothercare is one business that's on the high street, a retail business that has failed to innovate. It's had a lack of creativity. And the same old business practices that once worked on the high street with retail doesn't in the modern day. We've seen firms such as Debenhams, another retailer who refused to update themselves with the times, fall into administration and eventual bankruptcy. Well, Mothercare is still around, but it has failed to deliver for shareholders over the past 10 years, and that we will show shortly on a chart. But for now, we'll look at how the directors in the firm had insufficient skin in the game. Well, let's give a bit of context here. 3 directors had invested £120,000 in the company's shares at 10 pence a piece in a £3.2 million placing, so a fundraising, essentially. And for those who think that this is a sign of confidence, well, one of those directors alone had an annual salary of around £500,000, and more than 4 times what the 3 directors had put in as a total was the earnings of just one director. Now, the move at the time seemed to be a quick attempt to satisfy shareholders, but if we look at the performance in a bit, we will see that the shares performance really speaks for itself. And financials wise, Mothercare lost £87.3 million. How can a director earn £500,000 alone in a business that has lost £87.3 million and has continued to lose that much money? Those factors we just discussed, a lack of creativity, and insufficient skin in the game, these have contributed to what we'll now look at as the share's performance. Imagine being an investor over this period. You'd definitely be upset, with management probably as your first area to rant upon. But look, the shares were trading at £5.77 odd on the month beginning January 2010. So with chart perspective looking back, that's the end of this month in terms of trading data. And the shares decreased by 98.38%, as you can see, to 9.36 pence on the month beginning at September 20. So September 2020, so the end of September in a chart's context. Now that is a very ugly performance. And as an investor, or a long-term investor, you wouldn't like to consistently be in something like this that is in a trending market towards the downside and be long. You'd like to really short this on any retests of a simple trend kind of thing. Now, we ask ourselves, why is it important to evaluate management? Well, As an investor or a trader, you can reduce risks of one-off shocks, whether being long or short. And one-off shocks, for those who aren't familiar with them, regard unexpected events like accounting scandals as one example. A couple of real-life examples: Tesco, Patisserie Valerie, and so on. Those guys had some issues and their shares suffered as a result of those one-off shocks. Management refused, or rather failed, to protect the best interests of shareholders. And you can also be more confident in holding a stock for longer periods of times with ease. You can sleep at night and hold your investments without fear of poor management making some crazy decision that ends up destroying your shareholder value, like we see with a lot of small caps these days that decide to raise money at 40% discounts back to back to back, and before you know it, you've lost 99 odd percent or even 100% of your shareholder value when the company goes bust. And by looking at these examples and practicing, just as we do with technical analysis on the fundamental analysis side, by practicing regularly, you will be more accurate in terms of making your investment decisions. And by looking at regular examples, you will be able to hopefully improve your risk management in terms of management as well. It might sound like a weird situation, but think about it this way. If you do the research and you can prevent an investment that maybe you wouldn't have made if you did the research, you will be able to save yourself out on a lot of losses. That is an amazing situation. Or if you did the research into a company and actually saw the silver lining, made the investment, you will thus reap the rewards.